Welcome to all of you, Shiksha 360. And today, basically, we have to discuss chapter number 11, that is Bank Guarantee of LRAB. Clear? So, let's start. Under this session, basically, we will discuss some important points regarding the bank guarantee, basically, why it will be quite clear. So, let's start our discussion. So, in commercial transactions, clear, and one thing, please remember that basically one or two question definitely, basically, you will get. Clear, there are chances of 0.5 mark question, basically, you will get basically from this topic. So, let's start. So, in commercial transactions, banks customers are sometimes required to give a bank guarantee. Clear? So, basically, in commercial transactions, bank customers are sometimes required to give a bank guarantee. This is mostly as an alternative to keep cash as a security deposit. Clear? Like basically, at some places, clear, basically, you will have to give the bank guarantee. Clear? So, in the place of the cash, clear, this is to be used as an alternative. Clear? So basically where it will be used and what are the different types of guarantees, basically we have to go through. So the third party who seeks the guarantee, not being aware of the customer's financial standing, prefers a bank guarantee. Clear? Like basically you are dealing with any other person and they are not aware, clear, basically whether you are financial good or not. Clear? Or basically whether you are seems to be good and actually it is not that much good, or whether you are not seems to be good but it is actually good. Clear? So basically for all these cases, clear, basically what they will take, basically they will want the bank guarantee. Clear? That in the case of the default, clear, that in the case of the default they will take the help of that. Clear? Basically they will take the help of that and they will recover their money from that. So in turn, the bank which very well understands the financial standing of the customer. Clear? Because the customer dealing basically with the bank from the last few years. So in turn, the bank basically which very well understands the financial condition of the customer undertakes to guarantee the customer's financial commitments or the performance of contracts by him. Clear? Undertakes to guarantee the customer's financial commitments or the performance of contracts by him. Clear? Or the performance of contracts by him. Clear? And the bank will also give the guarantee. Clear? Basically by taking some security. Clear? That is in the case of the default by the customer. Clear? So basically they will able to recover their money back. Clear? Basically they are able to recover their money back. Clear? So basically they will take the things in that way. Clear? That they will not face any problem. Clear? Like basically in some cases, basically bank will take the fixed deposit. Clear? Or any other things. Clear? Basically they will take for giving the bank guarantee. Clear? So please remember these things. Okay, so the bank, along with that, the bank also charge the commission, like basically we can say that 1% or 2%. Clear? So the bank also charges a commission basically for the service, which depends upon the security available and the financial stability of the customer. Clear? Along with that, basically the bank charges a commission for this type of service, basically which depends on the security available and the financial stability of the customer. Basically, which depends upon the security available and the financial stability of the customer. Further, so what are the bank guarantees? So, what is first of all definition? So, bank guarantee basically briefly stated means a guarantee given by a bank to a third person. Clear? So, what is bank guarantee? Basically, it is a guarantee given by a bank to a third person to pay him a certain sum. Clear? That is basically to pay him a certain sum on behalf of the bank's customer. Clear? So basically what is bank guarantee? Bank guarantee basically briefly stated means a guarantee basically given by a bank to a third person to pay him a certain sum on behalf of the bank's customer when on the customer basically failing to fulfill any contractual or legal obligation basically towards that third person. Clear? Basically in which case basically bank has to pay. Bank has to pay basically in which condition? On the customer. Clear? Basically when the customer failing, when the customer is not able to fulfill any contractual or legal obligations. Clear? Basically when the customer is not able to fulfill its basically any contractual or legal obligations. Clear? Basically in that case they have to pay. Clear? In that case basically bank has to pay that much amount. Clear? That is basically known as the bank guarantee. Clear? So in this there should be a commitment on the part of the customer basically to fulfill certain obligations to a third party This could be contractual or legal. Clear? That is imposed by law. Clear? That is basically that commitment. Clear? So basically in this, first, there should first be a commitment on the part of the customer to fulfill certain obligations. Clear? Basically to fulfill certain obligations. Wait a minute. To fulfill certain obligations basically to a third party. So this could be contractual or legal. This could be contractual or legal. That is basically imposed by law. So this commitment of the customer, clear? Basically this commitment of the customer is granted by a bank. Clear? This commitment of the customer basically it is granted by the bank. And if the customer basically fails to honor his commitment, clear? That is basically if the customer is not able to pay the amount basically to that third party, so then who will pay that? The bank. Clear? So this commitment of the customer is granted by the bank, and if the customer basically fails to honor his commitment, the banker pays the amount if he has promised to pay. Clear? This commitment of the customer basically it is granted by the bank, and if the customer basically fails to honor his commitment, then the banker basically pays the amount if he has promised to pay. Clear? It has promised to pay. So once the bank gives a guarantee, clear? Once the bank basically gives a guarantee, then it's a commitment. Clear? So then basically it's commitment to honor the guarantee is onerous, and as such basically it is prudent that a banker before issuing a guarantee on behalf of his customer takes appropriate security and understand its rights and duties. Clear? Clear? So that is basically when the banks basically gives a guarantee. So basically in the case of the default by the borrower, clear? So then it's commitment. Clear? So basically then it's commitment basically to honor the guarantee. Clear? That is if the, like basically we can say that if there is a 50 lakh guarantee, clear, and the customer basically not pays amount to the third party, clear? So in that case basically customer basically will revoke the bank guarantee. Clear? So customer basically what will do, they will revoke the bank guarantee, that is known as BG, and the bank has to pay the amount in that case. Clear? And the bank has to pay the amount basically in that case. Clear? So please remember these things. Clear? These are very, very important topics basically for the examination point of view also. Clear? Definitely basically you will get question. Clear? So next thing basically we will have what are the advantages of the bank guarantee. Clear? So basically to the small applicant, small companies basically can secure loans. Small companies basically can secure loans or conduct business that would otherwise not to be possible basically due to the potential riskiness of the contract basically for their counterparty. Clear? That is basically they are dealing business with them, and that other party basically it is a big party. Clear? So basically sometimes basically we can say that we see that the bigger businessman basically will not pay money to the small businessmen. Clear? Or to the small companies on time. Clear? That is basically they can see that. Clear? On the other side also, clear, basically small companies are not able to pay the material, clear, or to cover the requirement of the big companies on time. Clear? So all these things basically they will take care while using the bank guarantee. Clear? So basically it will help us to maintain a decorum. Clear? So small companies basically can secure loans or conduct business basically that would otherwise not to be possible due to the potential riskiness of the contract for their counterparty. It encourages basically business growth. Clear? It encourages the business growth and entrepreneurial activity. Clear? Basically it encourages the business growth and entrepreneurial activity. So the banks basically charge low fees for the bank guarantees. Clear? Further, the banks basically charge low fees for the bank guarantees. Normally a fraction of 1% of the overall transaction basically for the assurance provided. Clear? So the banks basically normally charge low fees. Clear? So the banks basically normally charge basically low fees for the bank guarantees. Clear? Normally a fraction of 1% of the overall transaction basically for the insurance provided. Clear? Or for the assurance provided. Like basically we can say that if the bank guarantee is of 10 lakh, so basically they will take 1%. Clear? That is basically we can say that 10,000. Clear? It is the fees basically goes to the bank, or we can say that basically it is the commission basically goes to the bank. for that service provided. Clear? Now further, what are the, this is basically to the applicant, clear, to the applicant. Now basically what is benefits basically to the beneficiary, clear, to whom they are going to give the bank guarantee, clear. So the beneficiary basically can enter the contract knowing due diligence being done on their counterparty, clear. So the beneficiary basically can enter the contract knowing due diligence being done on their counterparty, clear. The bank guarantee basically further adds credit worthiness, clear. The bank guarantee basically adds credit worthiness to both the applicant and the contract, clear. So the bank guarantee basically adds credit worthiness to both the applicant and the contract. Next one, there is a risk reduction due to the bank's assurance, clear. Basically there is a risk reduction basically due to the bank's insurance, and they will cover the liabilities should the applicant default, clear. There is a risk reduction basically due to the bank's assurance that they will cover the liabilities basically should the applicant default. There is an increase in confidence in the transaction as a whole, clear. There is an increase in confidence, clear. There is an increase in confidence basically in the transaction as a whole, clear. So all these are benefits basically to the beneficiary, clear. That is, the beneficiary basically can enter the contract knowing the due diligence basically have been done on their counterparty. Second one, the bank guarantee basically adds credit worthiness, clear. The bank guarantee basically adds credit worthiness to both the applicant and the contract. Third one, basically there is a risk reduction, clear. Why? Because the bank is involved under that, and the bank will issuing the bank guarantee only basically after taking the specific security, clear. So that they will cover the liabilities basically should the applicants default. There is an increase in the confidence basically in the transaction as a whole, clear. There is an increase in the confidence basically in the transaction as a whole, clear, because the bank is involved under that, clear. The bank is involved under that, clear. So these are the benefits basically to the beneficiary, clear, basically who is going to deliver or basically who is going to be part in the contract. So bank guarantees and the letter of credits, clear, basically bank guarantees and the letter of credits are both used in the international transactions. However, the market basically for the bank guarantees is much larger than that of the LCs, clear, basically than that of the LCs, clear. So bank guarantees basically are often used, clear, basically like in the real estate and the infrastructure to mitigate the credit risk, clear. Like basically you can say that basically if a government basically gives any contract to any builder, clear, basically for the construction of any bridge or basically for the construction of the road, clear. So what they will do at that time, basically they want bank guarantee, clear, basically from the tender, clear. Basically if they are not able to complete the work on time, clear, or basically if there is any delay in the work, clear, so basically they will revoke that, clear, as per the terms and conditions, clear, basically as per the terms and conditions. Okay. So bank guarantees are often used in the real estate and infrastructure to mitigate the credit risk, that is basically to reduce the credit risk, whereas letter of credits are frequently used, clear, basically whereas letter of credits basically are frequently used in commodity markets or other international markets, clear, basically whereas letter of credits basically are frequently used in commodity markets or other international markets. So now basically we have to discuss basically what are the various types of the financial bank guarantees, clear, like financial guarantee, performance guarantee, clear. So now let's discuss regarding that one by one. So first of all, basically which we have to discuss here, that is the financial guarantee, clear. That is the financial guarantee. So let's start basically what they are trying to say here. So basically these are the guarantees, clear. Basically these are the guarantees issued by the banks basically on behalf of the customers, clear. These are the guarantees basically issued by the bank on behalf of the customer in lieu of the customer's requirement basically to deposit a cash security or earnest money, clear. So basically these are the guarantees, clear, that is basically issued by the banks, clear, basically on the behalf of the customer basically in lieu of the customer's requirement to deposit a cash security or the earnest money. So these types of guarantees basically are mostly issued on the behalf of the customers or contractors dealing with the government departments, clear. So basically these types of guarantees basically are mostly used on behalf of the customers or contractors dealing with the government departments. Clear? Please remember that basically financial guarantees basically dealing with the government departments. At that time, basically they are mostly issued. So such guarantees basically are also issued in situations. Clear? Basically such guarantees basically are also issued basically in situations where a party is required to deposit a cash basically as a part of the contract. Clear? As a part of the contract. So most of the government departments insist that before the contract is awarded basically that is to given to the contractor, he should show that he is willing to perform the contract, and also to ensure that no privilege now no no privilege standards are made. Insist on an earnest money deposit. Clear? That is, no privilege standards are made. That is, what is the meaning of that privilege standards? That is basically, it means that sometimes basically there are also tenders. Clear? Just they want to contract with the government, but they have not enough any efficiency. Clear? Basically to perform the work. Clear? So in that case, clear, basically to protect ourselves, basically from that case, the government basically will take this type of guarantee. Clear? That is basically in the case of the default, that bank guarantee it is going to be revoked. Clear? Like basically some tender basically are new in the business. Clear? And they will take the contract, and they have not enough capability. Clear? Basically to perform the job. Clear? So basically to protect ourselves basically from all these things, basically government basically will take this type of guarantee. Clear? That is the financial guarantee. Clear? So such guarantees basically are also issued in situations where a party is required to basically deposit a cash as a part of the contract. So most government departments basically insist that before the contract basically is awarded to the contractor, he should show that basically he is willing to perform the contract, and to ensure that no privilege standards are made. Insist on an earnest money deposit. Clear? Earnest money deposit. That is basically, it is an advance. Clear? Basically that they are interested to perform the contract. Clear? Like basically they are saying that basically if there is a contract of basically generally basically earnest money basically they will take it as 10%. Clear? As a 10%. Clear? And if the contract is not awarded to them, clear of, or if the tender is not awarded to them, so basically this money basically will be returned. Clear? This money basically will be returned, and there is no interest to be paid on that. Clear? Now move to the next one. However, in lieu of the earnest money, government departments are generally willing to accept a bank guarantee. Clear? Basically, in the case of the earnest money. Clear? However, in lieu of the earnest money, government departments are generally willing to accept a bank guarantee. This also helps the contractor. Clear? Basically, this further also helps the contractor who can utilize the funds. Clear? Basically, this also helps the contractor who can utilize the funds basically for fulfilling his obligations basically under the contract. Clear? However, in lieu of the earnest money, government departments are generally willing to accept a bank guarantee. Clear? Basically are willing to accept a bank guarantee. This also helps the contractor. Clear? Basically this also helps the contractor who can utilize the funds. Clear? Basically this also helps the contractor basically who can utilize the funds for fulfilling his obligations. Clear? Who can utilize the funds basically for fulfilling his obligations under the contract. Clear? Under the contract. In case the contractor basically does not take up contract of awarded, then the government departments basically will invoke the guarantee and collect the money. Clear? Basically, in case basically the contractor basically does not take up the contract. Clear? Initially, basically they are able to apply. And when the contract is allotted to them, clear? Basically they are saying that basically they are not able to perform that much work. So in that case, basically what the government department basically will do, basically they will invoke the guarantee and collect the money basically from the banks. Clear? Basically they will invoke the guarantee and collect the money basically from the banks. Clear? So this is the regarding the financial guarantee. Clear? Hope it is clear to all of you regarding the financial guarantee. So now here one question arises, that is basically what is earnest money. Clear? So earnest money basically it is a deposit made to a seller that represents a buyer's good faith to buy a home. Clear? That is basically the person is interested. Clear? That's why basically they are interested. Like basically there is a government, like basically government basically introduced a new colony. Clear? At some specific area. Clear? And they are inviting applications basically from the public that they want to sell some plots there, residential plots, or we can say that basically or some flats. Clear? So basically, in that case, basically you have to deposit the earnest money basically with the government. Clear? Earnest money basically with the government. That is basically you are interested to purchase that. Clear? That is basically you are interested to purchase that flats. Clear? So the money gives the buyer basically extra time to get financing and conduct the title search, property appraisal, and inspection basically before closing. Clear? This is basically just you have to remember that basically what is earnest money. Okay, so basically there is one question on the same. If a bank guarantee basically is issued by a bank in lieu of a customer's requirement to deposit a cash, security or earnest money, clear? So then which guarantee it is that? Clear? So basically if a bank guarantee is issued by a bank in lieu of the customer requirement basically to deposit a cash security or earnest money, clear? So basically it is a which type of guarantee? Financial guarantee, performance guarantee, deferred payment guarantee, or any of the above? So basically it is the financial guarantee. Clear? So option number A is the answer, that is the financial guarantee. Clear? So basically next guarantee basically which we have to done, that is basically the performance guarantee. Clear? So basically these are the guarantees issued by the bank. Clear? Performance guarantee, basically these are the guarantees basically issued by the bank on behalf of the customer. Clear? Whereby the bank ensures that third party. Clear? So these are the guarantee basically issued by the bank on behalf of the customers, whereby the bank ensures that assures a third party that the customer basically will perform the contract. Clear? Basically the customer basically will perform the contract entered into by the customer as per the condition. Clear? That the customer basically will perform the contract entered into by the customer as per the condition stipulated in the contract. Clear? Basically entered into by the customer basically as per the condition stipulated into the contract, failing which the bank will compensate the third party. Clear? Basically failing which the bank will compensate the third party up to the amount specified in the guarantee. Clear? Failing which basically the bank will compensate the third party. Clear? Failing which basically the bank will compensate the third party up to the amount specified in the guarantee. So these types of guarantees, clear? Basically these types of guarantees are usually issued by the bankers. Clear? So basically these types of guarantees basically are usually issued by the bankers basically on behalf of their customers who have entered into contracts basically to do a certain things on or before a given date. Clear? That is basically these types of guarantees basically are generally issuable where there is a contract that is basically based on the performance. Clear? That is basically they are able to do that work or not. Clear? That is basically they are able to do that work or not. Clear? So the bank ensures that the condition that stipulated in the contract will be complied with by the customers in practice. The banks, on being served a notice of default by the third party, pays of the over the guaranteed amount without going into the technically of the contract. Clear? Basically when the notice is to be served. Clear? Basically when the notice is to be served. Clear? By the party. Clear? To the bank that the third that there is a default. Clear? By that party. So the bank basically will not go into any technical conditions. Clear? Basically where the default will occur. Clear? The bank basically revokes the bank guarantee and pays the amount to that party. Clear? So the bank ensures that the condition as stipulated in the contract basically will be complied with by the customer in practice. The banks, on being served a notice of default by the third party, pays over the amount granted without going into the technicality of the contract. So this is because after a guarantee is issued, clear? This is because after a guarantee is issued, the contract of guarantee is independent of underlying commercial transactions. Clear? This is because after a guarantee is issued, the contract of guarantee basically is independent of underlying commercial transaction, and any claim as per terms of guarantee is required to be honored. Clear? And any claim basically as per terms of guarantee is required to be honored. Though in certain performance guarantees, clear? Basically though in certain performance guarantees a clause is inserted that proof of default of the customer is necessary. Clear? In some guarantees basically there is a special clause. So in certain performance guarantees, basically a clause is inserted that the proof of default of the customer is necessary. And the most bank guarantees basically do not insist on such proof. A mere demand basically from the beneficiary that there has been a default Clear? In most of the cases, basically there is not any clause. Clear? Just a mere demand basically from the beneficiary that there has been a default by the customer, bank's customer, is sufficient basically for the bank basically to make the payment. Clear? Is sufficient basically from the bank to make the payment. Clear? So that is basically known as the performance guarantee. Clear? So let's discuss one question on the basis of that. Bank B issued a guarantee whereby it is assured a third party that the borrower basically will perform the contract entered into basically between the borrower and the third party. Clear? Bank B will issue a guarantee whereby it is assured that a third party that the borrower basically will perform the contract entered into between the borrower and the third party. Failing which, clear, if they are not able to perform, clear, failing which the bank shall compensate the third party. So basically it is an indemnity, financial guarantee, performance guarantee, or deferred payment guarantee. Clear? So it is basically it is a performance guarantee. Clear? So please go through the definitions very carefully. These types of question basically you will find in the examination. Clear? Directly. You are able to answer the questions only if you are go through the definitions very carefully. Clear? So hope it is clear to all of you regarding the bank guarantees. So in the next session, basically we will discuss regarding the deferred payment guarantee in detail. Clear? So thanks to all of you for joining this session.